67%. That's the share of home sales in Miami-Dade that are now happening in cash. No mortgage, no lender, no 30-year fixed rate, just a wire transfer and a signature. And here's the part that should actually worry you. That number isn't a sign of a healthy market flush with rich buyers. It's a sign that financing itself is disappearing quietly, town by town, and taking regular American buyers down with it. Because when a bank won't touch a building, when an insurer won't write a policy, the only people left standing at the closing table are the ones who don't need either one. So today, we are counting down 12 Florida towns where the mortgage is becoming an endangered species, and unpacking exactly why the disappearance of financing is rewriting who gets to own a home in this state at all. On number 12, Hallandale Beach, where the blacklist finally caught up. This city sits wedged between Hollywood and Aventura, packed with mid-rise condo buildings from the 70s and 80s that used to be the easy entry point into South Florida living. Not anymore. Here's the breaking point. A huge share of Hallandale's older buildings have landed on Fannie Mae's ineligible list, the so-called condo blacklist, meaning conventional lenders simply will not issue a loan on them, full stop. No exceptions, no negotiating. So picture a young couple, decent credit, steady income, ready to buy their first place. They find a unit they love, they get pre-approved, and then the lender comes back with one word, denied. Not because of their credit, because of the building. That's the twist nobody explains until it's too late. Would you keep house hunting somewhere your own bank refuses to follow you? Most buyers here don't. They just leave the list to the cash crowd. On number 11, Hollywood, the middle-class squeeze. Hollywood used to be the affordable cousin sitting quietly between Miami and Fort Lauderdale, the place where teachers and nurses and city workers could actually buy in. Here's the breaking point. Insurance premiums on older buildings here have climbed so fast that lenders are now requiring buyers to prove coverage before they'll even finalize underwriting. And in a growing number of cases, no carrier will write the policy at all. No policy means no mortgage, full stop, no matter how strong the buyer's paycheck looks on paper. So imagine spending months saving a down payment only to lose the deal at the finish line because an insurance company somewhere decided your zip code isn't worth the risk. Meanwhile, cash investors circle those same listings, scoop them up at a discount, and rent them right back to the very families who got denied. Would you want to compete against a buyer who doesn't need anyone's permission? Hollywood's middle class is finding out the hard way that they do. On number 10, North Miami Beach, where the appraisal gap swallows the deal. This city is packed with agging waterfront buildings that technically still have value on paper, but here's the breaking point. Once a building lands on a lender restriction list, appraisals start coming in low because appraisers have to price in the fact that most buyers literally cannot get financing there. Low appraisal means the loan amount shrinks even for the buyers who do qualify, and suddenly they're being asked to cover tens of thousands in the gap out of pocket, cash they don't have. So picture a retiree trying to downsize into a smaller unit here, only to watch the numbers fall apart 3 different ways before the ink ever dries. Cash buyers don't care about appraisal gaps. They just write the check. Would you keep fighting a deal that keeps shrinking every time you look at it? Most regular buyers just walk. On number 9, Deerfield Beach, the reserve study reckoning. Deerfield's coastline is lined with older condo towers that spent decades underfunding their reserves, and now the new statewide rules are forcing every building to show its real numbers. Here's the breaking point. When a structural reserve study reveals a building is millions short, lenders treat that building as financially unstable, and many simply stop approving loans there altogether, regardless of the individual buyer's finances. So the pool of qualified purchasers doesn't just shrink, it collapses overnight for that entire building at once. Picture an owner trying to sell a perfectly livable unit, only to discover their own building is now unfinanceable, and the only offers left on the table come from investors paying 20% under value because they know exactly how cornered the seller is. Would you sell your home for less than it's worth just because the paperwork scared everyone else away? That's exactly what's happening here, week after week. If you're trying to figure out where financing is still working in Florida versus where it's quietly disappearing, hit subscribe. We track this data every single week, so you're not the one finding out at the closing table. On number 8, Pompano Beach, when insurance denies before the bank even asks. Pompano's older beachfront stock has always attracted first-time buyers chasing a slice of coastline on a normal salary. Here's the breaking point. Several major insurers have quietly stopped writing new policies in specific Pompano zip codes altogether, meaning buyers can have flawless credit and a fully approved mortgage and still lose the house because nobody will insure it. Lenders require proof of coverage before closing, no exceptions, so an uninsurable house is functionally an unfinanceable house. Picture getting to the very last step, movers booked, keys practically in hand, and having the whole thing collapse because an insurance underwriter 3 states away said no. Cash buyers skip that step entirely. No lender, no required policy, no problem. Would you want to buy in a market where the finish line keeps moving? Pompano's regular buyers are learning they don't have a choice anymore. On number 7, Coral Gables, luxury math with an asterisk. Coral Gables still looks like old money Florida, manicured, historic, expensive. But here's the breaking point. Jumbo loans on properties here increasingly require larger reserves and stricter insurance documentation than conventional financing, and a growing share of lenders are simply declining to underwrite anything near flood zones without ironclad, fully paid coverage in place first. That process alone can stretch a closing out by months. Meanwhile, an all-cash buyer closes in days. So picture 2 buyers competing for the same historic bungalow, one financed, one cash, identical offers on paper. The seller takes the cash buyer every single time, not because the offer is higher, but because it's certain. Would you bid on a house knowing you're structurally slower before you even submit the offer? That's the quiet advantage reshaping who wins in Coral Gables now. On number 6, Boynton Beach. The retiree lockout. Boynton has long been a landing pad for retirees looking for something a notch more affordable than Boca. Here's the breaking point. Many of its 55 and over condo communities are now sitting on underfunded reserves, and once lenders flag a building, refinancing existing units becomes just as hard as buying new ones. That traps current owners who need to pull equity for medical bills or repairs and locks out the next wave of retirees who need a mortgage to get in at all. Picture a widow trying to refinance to cover a special assessment, only to be told her own paid-off building doesn't qualify anymore under the new guidelines. Cash investors buy her unit instead, at a steep discount, because they're the only ones who can move without a bank's permission. Would you want to grow old somewhere that quietly stops letting you access your own equity? Boynton's retirees are discovering they don't get much say in it. On number 5, Lauderdale by the Sea, when the whole inventory turns cash only. This is a small beach town, but here's the breaking point, and it's a stark one. A significant chunk of the active listings here now sit in buildings that are entirely ineligible for conventional financing, meaning the realistic buyer pool for those units has been reduced to cash investors and self-funded retirees almost exclusively. When that happens to enough of a town's inventory at once, it stops being a housing market and starts being an auction house. Picture a whole stretch of oceanfront units where the listing price barely matters anymore because the real negotiation only happens with buyers who never needed a lender's blessing in the first place. Would you want to buy into a town where the price isn't really the price for you specifically? That's exactly the math regular buyers in Lauderdale by the Sea are running into now. On number 4, Aventura, the $400,000 filter. Aventura's high-rises are some of the most recognizable towers in South Florida, but here's the breaking point, and it's brutal. Special assessments here have already hit as high as $400,000 per unit in some of the older buildings, and once an assessment that size lands, lenders treat the entire building as a financial liability, freezing new mortgage approvals across every unit inside it, not just the one that got hit. So even owners trying to sell a completely separate, unaffected unit in the same tower suddenly find their buyer pool wiped out overnight. Picture owning the one unit that never needed repairs and still losing every financed buyer anyway, purely by association. Would you want your home's value tied to your neighbor's roof? In Aventura, it already is, and cash is the only workaround left. On number 3, Sunny Isles Beach, the international cash fortress. Sunny Isles has always leaned heavily on international buyers, but here's the breaking point. As domestic financing tightens across nearly every older building in the corridor, the share of transactions closing in cash has climbed dramatically, and that share is now dominated by buyers who were never going to use a mortgage anyway, foreign nationals, family offices, and high-net-worth investors parking money in real estate. That means the properties functioning worst for financing are functioning best for this specific buyer class, effectively converting entire buildings into a private cash-only marketplace. Picture a regular Florida family walking into a sales office here and realizing they're not actually competing with other American buyers anymore. They're competing with capital that has no interest rate to worry about at all. Would you bid against money that doesn't blink? Most locals here have simply stopped trying. On number 2, Surfside, the ghost that rewrote every rule. You already know why this name matters. Here's the breaking point. After the 2021 collapse just north of here, every single older building in this stretch of coastline came under a level of scrutiny nothing else in the country has faced, and the resulting reserve requirements have made a meaningful share of surviving buildings functionally unfinanceable until they complete full recertification. That process can take years and cost owners tens of thousands of dollars before a single new buyer can even get approved for a loan. Picture trying to sell your home in the shadow of the very tragedy that rewrote the rulebook, watching buyer after financed buyer walk away simply because the paperwork isn't finished yet. Cash buyers don't wait for paperwork. Would you want to be the seller stuck, holding a property nobody with a mortgage can touch? Surfside owners didn't choose this position, but they're living in it anyway. On number 1, Brickell, ground zero for the disappearing mortgage. If there's one neighborhood where financing has functionally vanished, it's here. Brickell is packed wall to wall with towers built in the boom years of the 2000s, and here's the breaking point that puts it at the top of this list. Industry estimates suggest more than half of Florida's older condo buildings are still non-compliant with the state's new structural requirements, and Brickell has one of the highest concentrations of exactly that kind of aging inventory in the entire state. Combine that with sky-high HOA dues, insurance premiums that have doubled in some towers, and reserve studies revealing shortfalls in the millions, and you get a neighborhood where a huge share of listings are effectively locked out of conventional lending altogether. So picture the actual buyer pool left standing: cash investors, international buyers, and wealthy downsizers who never needed a bank in the first place, bidding against each other while everyone else gets quietly filtered out before they even submit an offer. That's not a housing market anymore in the traditional sense. That's an auction for people who don't need permission. And that's exactly why Brickell takes the number 1 spot. So here's the big picture after all 12 of these towns. This was never really a story about home prices. It's a story about who's even allowed to compete for a home in the first place. When insurance carriers walk away and reserve studies expose the truth, lenders don't just get cautious, they get out entirely, and once they're out, the only buyers left are the ones who never needed them. That's not a healthy market sorting itself out. That's a market quietly narrowing down to a single type of buyer, while everyday families with steady jobs and decent credit get filtered out before they ever reach a closing table. So if you're shopping in Florida right now, here's the one thing worth checking before you fall in love with any listing. Ask directly whether the building is currently financeable through a conventional lender, not just whether you personally qualify. Because increasingly in this state, the house isn't the obstacle, the building is. And if you don't check that first, you might find out the same way thousands of buyers already have, at the very last step, with the keys somehow still out of reach. All right, that's the countdown. 12 towns, one uncomfortable truth about who Florida's housing market is actually built for now. If this connected some dots for you, hit that like button, drop a comment telling me which town surprised you the most, and subscribe so you don't miss what we break down next. Thanks for sticking around till the end. See you in the next one.